Okay, thank you for waiting. Morning, everyone. This is Lin Sin, your consumer and healthcare analyst. Today we have a few results to go through. I'm sorry that Paul and Guangzi are in a meeting at the moment. So I'll just briefly take you through the results for Asian Pay TV, China Everbright, and CNMC. So for Asian Pay TV, we have downgraded to accumulate because of the recent price run-up, and our target price remain unchanged at 64 cents. As for China Everbright, we maintain our buy call with 59 cents target price. As for CNMC, we maintain our neutral call with 30 cents target price. With that, I would like to move on to HMI. Sorry. So for HMI, what basically happened in the first quarter of their financial year 18 is that we've seen a healthy or a rather strong growth in the foreign patient load, where it grew at 38% year on year. This is the strongest ever since FY15. And as for local patient, it continues to grow as well at 7.6% year on year. We have seen that Malaysian hospitals are actually picking up the slack from the slowdown of medical tourism in Singapore, and this is the perfect example that you can see. So foreign patient load are mainly coming from Indonesia side as well. So if you know that foreign patient are actually the main top line driver for their revenue for healthcare services. And do recall that foreign patient usually they will spend or they have a higher average bill size as compared to local patient. It's at about 1.4 to 1.5 times. And for this particular quarter, although that we've seen the patient mix for local to foreign are actually at about 80 to 20. Foreign patient actually contribute about 30% of the top line. So we continue to expect that patient load growth to remain healthy. And the next thing to note is that they are on track to pay down 50% of their acquisition debt as what they have promised in March this year. So they have already paid down about 35%, and then they have a remaining of 25 million ringgit to pay for the next coming quarter. And we think that this is achievable given that they have a very strong cash flow generation from their operating activities. So for the last quarter, they actually generated about 31 million ringgit. Another corporate update to take note of is that California actually invested about 2% stake in them. But management shared that at the moment they do not have any concrete plan on how to use these proceeds yet. And on near term as well as the medium term catalyst would remain as the upgrading and the expansion plans for the two hospitals in Malaysia, namely Mahkota as well as Regency. So both hospitals will add 34 operational beds each by end of this financial year. So this will give the total bed capacity to 500 by end of FY18. And for Regency side separately, they are going to commence the construction of the hospital extension block by targeting by FY18, and they are still pending some approvals coming from government. And this this extension is going to double their current capacity in Regency from 218 to 500 bed eventually, and is slated to commission in FY 2021. So with that, we maintain our buy call with our target price unchanged at 83 cents. And sorry, let me backtrack a bit. If you would like to compare like to like, for at the bottom line, probably you should look at the NPAT level, because in the past quarter, they have actually consolidated their non-controlling interest in the two hospitals, hence leading to the doubling or more than 100% growth in the PATMI level. Nonetheless, NPAT, if you see that there's this 5% down, this is because of the higher finance costs as well as FX losses. But if you exclude these non-operational and one-off items, core NPAT actually grew by 1.4%. So yep, moving on to Old Chang Kee. So for Old Chang Kee, top line grew for the first half of their FY18 at 8% year-on-year. So we continue to see that there's a healthy top line growth, but at the gross level, we are seeing that there's some compression coming in for the gross margin. It's mainly due to higher raw material costs as well as the one-time factory test runs. So raw material costs are mainly coming from higher chicken prices. So what happened basically in the past quarter, in the second quarter FY18, is because of the one-time integration costs. So this actually disrupt their Puff Innovations, and recall that Puff Innovations are actually their key driver of their top line, one of the key drivers for their top line growth. So the other impact would be the integration cost, which I've just mentioned. It actually weigh on the gross profit level, and as you know that for this test runs, they have to run in batches and in bulk, and it's not for sale, and hence we've seen that this actually pressure the margin. Nonetheless, having said that, the management shared that majority of the factory integration has actually completed and is on track for full integration by 3Q FY18, and production has now stabilized with the higher production capacity as well as efficiency. So what we are seeing that probably we are reaching the end of the tunnel, and by the fourth quarter, we should be seeing that there's some improvement coming from the more advanced factory equipment. Having said that, if you can recall that for Old Chang Kee, their gross margin usually historically it was at 63% level, but due to the higher raw material costs, we do not think that it will revert to 63% level by end of this financial year. They also have announced an interim dividend of 1.5 cents, the same as last year. So with that, we remain upbeat on the new factory, and we maintain our rating of buy with target price of 98 cents. Next, I'd like to briefly talk about this new IPO that would be closing by that will be closed for subscription by today, and should resume on trading on 22nd of November. So RE&S, as you can see that there are plenty of brand names that you are familiar with. I believe that especially the Ichiban Sushi as well as Ichiban Boshi. So Korea is actually at the higher end, where the average ticket price is at about 150 to 200 per person. As for Ichiban, it will be of lower teens to 20 per person. And yep, with that, let's take a look of into this company. So as you can see just now from the list of brand names, RE&S is actually a operator of F&B outlets in Singapore and Malaysia that provides authentic Japanese cuisine. So they have a total of 39 full-service restaurants. So full-service restaurants are those restaurants that provide customers to sit in and enjoy the full dine-in experience. So these 39 full-service restaurants contribute to about 74% of the top line, and they also have 38 quick service restaurants, food kiosks, Japanese bakery, as well as food retail outlets. So these are to cater for those takeaways or have smaller sitting areas. And so these contribute about 26% of the top line. The group also supply Japanese food products, mainly manufactured from the central kitchen, and this will be supplied to third-party businesses in Singapore. One of them would be one of the major supermarket chain in Singapore. So they are supplying things like sushi or onigiri and bento boxes. So this is just a rough contribution from by geographical location. So mainly coming from Singapore, 96%, and others are actually coming from Malaysia, Japan. Yeah. They don't have any fixed dividend policy at the moment, but they intend to distribute dividends of at least 35% of PATMI by end of this financial year 2018, as well as next year, financial year 19. And take a brief look at the IPO stats, where they are issuing new shares of about 54 million. 35 million will be under the placement tranche. For public, it will be 3 million. And for Cornerstone placement, it will be 60 million. So Cornerstone is actually this Orchid 2 Investments, which is an investment arm of Heliconia. So Hiroshi Tatara and John Yek is both of them are the co-founders of RE&S. We have conducted a SWOT analysis for RE&S. So for the strength, we believe that it lies within its very diversified business portfolio. It has about 20 unique brands under its portfolio. So this actually gives them an advantage in bargaining for new or to renew leases, because they will be able to take up a larger retail space, and they can offer a variety of brands under the same shopping mall as well. They also have offer multiple price points strategy, where they can capture different market segments. And this also helps to diversify the risk of a fast-changing consumer preference. And another strength would be coming from the central kitchen, where they will be able to benefit from the economies of scale. And this also provides them an ability to scale up fast. The opportunities that we've seen that we expect from this company is mainly coming from this increasing its sales channels under consignment arrangement or via online food delivery. Although that currently for online food delivery, they are still at the infant stage. They are still trying to research and R&D on to maintain the quality as well as the standard of the food being delivered. As you know that, like for example, tempura, it cannot be the quality would be different after the 40 minutes of delivery time. So these are the areas that they are looking into. And another opportunity would be tapping into the market for ready-to-eat meals. Later I'll talk a bit more on this. And weakness as well as threats are actually quite similar across the F&B industry. As for the financial highlight, as you can see that the bottom line took a dip in FY16. This is mainly due to their restructuring where they have closed down a few of their full service restaurants as well as opening of a few quick service restaurants. This actually caused their bottom line took a hit, but it recovered last year in FY17. The key components of their operating expenses will come from staff costs as well as rental costs. And for their margins wise, as you can see, that is hovering about high 71 to 72-ish, and we believe that the overall margins should improve as they continue gain from economies of scale from the central kitchen side, and as well as when they ramp up the quick service restaurants. Something we would like to highlight for the first half 18 earnings are which might impact the bottom line. Firstly would be the downtime costs and equipment write-off coming from the reconstruction of Shokusu 10 Food Street in Jurong Point, where they have converted into a Japanese food alley. This happened in the first quarter of this financial year, and the second quarter would be impacted by the IPO expenses. So earnings should normalize in the second half. And the other thing to note is that post-IPO, we believe that the financial position should improve. Currently, the company is in a net debt position of 13 million. Post-IPO, it should improve to about 2.7 million with net gearing at about 20%. And we believe that the debt is manageable with a healthy operating cash flow generation of over 17 million per annum. Next, I would like to explain a bit more on the fast-growing QSR segment, which we think that it should provide a leg up for the company's bottom line growth. So what they are trying to do is that they are focusing to ramp up their quick service restaurants outlets. So you can see that it's highlighted in the light blue column. The light blue bars, and at the same time you can see that the growth is actually outpaced the full service restaurants as well. And if you look at the margins, it actually has higher margins compared to the full service restaurants. So why are we so upbeat about this quick service restaurants strategy that they are focusing on? Is because that quick service restaurants is more scalable, easier to expand in terms of number of outlets. It has a lower capex compared to the full service restaurants. It requires lower operating costs, and it has a faster turnover. And another thing is that they can leverage on the factory capacity to ramp up production for its takeaway and ready-to-eat meals. So just to bring you through their central kitchen's facility. So their central kitchen is located in Tai Seng. They have about 12 food processing lines, and current utilization rate is at about 60%. So meaning that they have more room to grow, especially to tap on to when they ramp up their quick service restaurants outlets. So what do they have in their central kitchen is one thing to know is that they have a lab to test for microbe when they receive the raw materials. So if you know that like for example sashimi, you require this kind of lab testing for safety as well as quality. Then another thing is the rice line, where they is fully automated for them to cook as well as to cool the rice. Then another example would be on the tamago line, where previously it's all manual. They have 2 staff, and the productivity is like 20 tamagos per hour. But now with the fully automated equipment or machine, they can, with the same number of staff, the production increase 5-fold. So about 100 tamagos per hour. This is their packaging line. So we did a peer comparison across the F&B industry, and as you can see that they have, you can see from here clearer, where they have higher than peers growth in terms of EBIT level, operating level, as well as the bottom line. Although that their margins are lower than peers as well as their nearest competitor, Japan Foods. But we believe that this should improve in time when they increase the utilization for their central kitchen, as well as when they ramp up more QSR outlets. Also to note that they have a relatively higher ROE as compared to Japan Foods as well. So with that, we deem this IPO to be a good subscription with the IPO price of 22 cents.
Yeah, hi, this is Paul here. Just an update on the Asian Pay TV results. The title is because they've provided guidance for their FY18 dividend per unit. Okay, I'll move on to the results. In terms of the results, the key positive was obviously that management has guided 6.5 cents paid quarterly for next year. So that implies, based on the last current price, of about 10.9% dividend yield. The other positives that we saw on the results was the critical cable subscribers were stable and the churn rate was low. Just to recap, most of the bulk of the revenue comes from their pay TV cable subscribers of about 700,000, and it's important that this remains stable as they provide the recurrent income for the company. And the other positive would be they've suffered in the past because of the large capex rollout of their of their premium digital cable, because the authorities required all boxes to be digitalized. So basically, they were providing an extra setup box for free. The capex will end in 2017, so we will get a lower capex in FY18. In terms of the negatives, what we saw was the ARPU was sluggish across three business segments: pay TV, broadband, and premium TV. It's important that as with this stable base of pay TV subscribers, what is critical for Asian pay TV is to try and upsell their current services in terms of premium TV and also the high margin broadband. Do remember that broadband is one of the most is the highest margin product because there's basically no content cost to be paid. You're just providing access. The other negative, if you look at the table, you notice that they pay dividends about 23.3 million per quarter. The free cash flow is about around 20, so they do need to draw down a little bit of debt every quarter, about 2-3 million. So, but we hope that this will improve next year as capex decline, and as a result, you will probably see lower interest. If you note from the table, you can see that the interest has declined partly because there have been a 30 basis point savings because of the new trustee manager owners linked to the Terry Kuo of Hong Hai Group. That's why they managed to lower down the interest expenses paid. In terms of outlook, we downgraded the stock to accumulate, but this is purely because of the price appreciation. If you recall, anything above 20% is a buy, and anything below is accumulate. The total return is about mid-teens, high teens. So as a result, it didn't meet the cutoff. There's been no change in the fundamentals despite this downgrade, just that the price is appreciated. And our final point at the bottom, basic outlook is basically stable, and we expect better cash flows as the premium digital capex ends. Yep. Thank you. We'll move on next to Kwong Che for his results. Kwong Che is engaged in a conference. Let me just do a quick update for you on his results. Basically, for Everbright, the results were in line. What we like about this stock is that they're getting a strong pipeline of new projects, and as you know, they do generate revenue from construction activity, and you can see that they've under construction about 10 projects. So this could keep the revenue momentum strong. Thematically, if you look at the last bullet point in the recent National Party Congress, the emphasis remains on environment protection, and this thematically will benefit China Everbright. But do note there were 2 points made by him in terms of the risk. One is if we look at the bottom point here, some local governments. So basically, the fiscal position of the local governments is a big, and we do expect some the payments to be dragged on for a little while longer. Okay, I'll move on to his next, which is CNMC. Basically, we still have a neutral. As you can, it's the obvious. The results is pretty obvious. The results is extremely poor due to the poor quality. But what is everyone's looking for is the new CIL plant, which could help with the low quality, kind of improve the output and efficiency of the grade that's produced. And the other interesting point to note is that they've got 18,000 tons of higher grade oil being stockpiled, and this would at least provide some visibility in terms of their production in future as they're stockpiling this as the new plant gets built up. That's it for me. Thanks.
Okay, good morning, clients. Before the analysts answer your questions, I'd like to bring your attention to our official Phillip research website called Stocks BNB. If you haven't been to this website, it's where our research materials are posted and available for your reading and learning. We have the research reports, webinar recordings, and PowerPoint slides, as well as technical pulse for you to help in your daily investment activities. So I would like to bring your attention today to our two new features on our website. Firstly, if you were to click on any of our research reports, you'll see that there's now a comment section below the report, and this is a space for you to write your views or your comments about the research report that you have just read, and you can add your opinions, give feedback, or suggestions for improvement. So this is the area that you can post your comments in. Another feature that I'd like to bring to your attention is the Talk to Analyst tab here. This is a community-based feature for subscribed Stocks BME users and in future our OEMs users to reach our research team easier. Here you can start a new topic. You have to log in first, and you can start a new topic by asking a question or open a discussion topic on specific stock or event for research team and the community to answer. This is a closed group. This is a closed group feature where you have to log into your Stocks BNB account or have to sign up for an account to post and reply. Yep. So do check out and explore the website today and spread the word to your clients and friends. For any queries, you can send an email, drop us an email at research@phillip.com.sg. Yep. Thank you. And now the analyst will answer your questions.
So there's a question on whether we have a target price for RE&S. Sorry, this is just an IPO note. We do not have a forecast for this company, but if you want to take a PE derived target price, then you can actually look at the closest competitor, Japan Foods, which actually have a PE of 17 times. Yeah. Okay, the other one is that whether we have a concern on the high leverage of RE&S and the owners are cashing out 12 million before the IPO. Yes, if you look at the net gearing ratio is actually at 52 or 53%. But if you look at post IPO, sorry, so post IPO it should go to about 20%. So and as we mentioned just now, we think that this debt level should be manageable. And we don't really have a concern on the owners cashing out 12 million. In fact, the management is very dedicated in the company, in the sense that some of the deposits paid for the outlets are actually coming from the founders themselves, and they did not ask sorry, and they did not ask to they did not ask for a return before the IPO.
Hi, there's a question on what's the stocks BNB site address. So if you see this page right here, there's the QR code, or you can alternatively type stocksbnb.com on your browser and it will lead you to the website. Hi, there's a question on if you are currently a points user, do you need a separate account for stocks BNB? For currently we have not implemented poems login for stocks BNB, but we are in the process of doing so in the very near future. So for now, you will need a stocks BNB account in order to access the reports and the community page. Thank you.
Hi, we have a question if there's any analysis on the banking sector. Yes, so we have a buy call for our banking sector. So you can stay tuned for much better results going forward. The only thing is that maybe in the fourth quarter you might see a little bit of I mean, most of spring cleaning is already done, so maybe just a little bit, but nonetheless, the strong loans growth will still be the main theme, and we can expect the net interest income growth to be on the mid-single to high single-digit percentage year on year. That is a marked improvement from the last a few quarters. So these are extremely positive signs for us. Thank you.
If there are no more questions, we'll end this webinar today. Thank you for tuning in, and we'll see you next week. Thank you.